Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. It's a curious case indeed when the market throws us a curveball, especially with a stock as widely discussed as Z Entertainment Enterprises Limited. Early this year, something truly remarkable, even historic, unfolded with Z's stock price. For the first time in an entire decade, in fact, the first time in more than 2 decades, the stock actually dipped below its book value. Think about that for a moment. Not a single day in the last 20 years, not even during the chaotic peaks of the COVID crisis, did Z's stock price fall below this crucial marker. This was without a doubt a momentous occasion for the company's stock. Now I can almost hear your thoughts. Book value for a media stock like Z? Isn't that irrelevant? Should we not be looking at things like price to earnings for a company that deals in content and entertainment? Well, I find myself a little neutral on these sorts of valuation debates. Let's consider a simple analogy. If you're trying to figure out the worth of a tree that reliably produces fresh, delicious fruits every year, does it really matter if you value the tree itself or the basket of fruits it yields? In the end, the final value you arrive at should be pretty much the same. The same logic, to a large extent, applies to companies. You can approach the valuation by looking at the earnings they generate, or you can look at the tree, their book value, which is essentially the foundation that helps produce those earnings. Ideally, the outcome should not be drastically different. So let's circle back to Z's book value and take a closer look at its balance sheet. Now, Z boasts a substantial balance sheet, coming in at a hefty rupees 14,000 crores. Here's where it gets interesting. Nearly half of this impressive sum, around rupees 7,000 crores, is made up of something called inventory. Now, for media companies like Z, inventory isn't quite what you'd find in a typical retail store. Instead, it represents the content they either create themselves or acquire from external sources. Think about a movie they've bought the streaming rights for or a TV show they've produced. The financial benefit from this content doesn't just disappear after one viewing, it continues to generate revenue over several years. Because of this ongoing benefit, media companies like Z are allowed to amortize this cost over a period of time. Let's break that down with an example. If Z spends rupees 50 crores to buy the streaming rights to a popular movie, the entire rupees 50 crores will initially show up as inventory on their balance sheet. Instead of writing off the whole amount at once, they might spread that cost out, say equally over 5 years. So each year, 1/5 of that rupees 50 crores, which is 10 crores, would be recognized as an expense, slowly reducing the inventory value on the balance sheet. Now, since ZTV is constantly churning out new shows and acquiring fresh content, their inventory has, understandably, continued to grow steadily over time. To put things into perspective, Z currently has a book value of around rupees 130 per share. And out of that, the value attributed to inventory alone is quite significant, close to rupees 70 per share. Now, historically, Z has often traded at around twice its book value. This means that if we simply assume that these historical valuation patterns will continue, the market could potentially push Z Entertainment stock price towards rupees 260 per share. That's a pretty appealing prospect, isn't it? However, here's where we need to introduce a dose of reality and a bit of caution. What if we believe that Z has been a bit too optimistic, perhaps even aggressive, in how it values its inventory? Now, it's not uncommon for companies to have different approaches to valuing their assets. If we decide to apply a discount, say of at least 30% to the book value of this inventory, then the inventory's per share value would fall from rupees 70 to a more conservative rupees 50. In this scenario, Z's total book value would drop to around rupees 110 per share. Even with this more conservative book value, if we still apply the historical 2 times price to book value multiple, the fair value for the stock would be around rupees 220 per share. Still quite a decent upside. Now let's push this idea even further. What if we assume an even larger discount for the inventory, perhaps a 50% reduction? Well, in this more pessimistic but potentially realistic scenario, the total book value per share would fall to roughly rupees 95. Applying the 2 times price to book multiple to this figure would suggest a fair value of rupees 190 per share. So as you can see, we've arrived at 3 distinct fair values for Z Entertainment, leading to 3 different possibilities for its future stock price. And honestly, there could be even more variations depending on how you personally choose to assess and value that crucial inventory. Ultimately, your decision on whether to invest in Z Entertainment will largely hinge on your personal assessment of how that inventory is valued. This is where you need to tread carefully. Be realistic in your assumptions. Don't shy away from being a bit conservative if you feel it's warranted. But at the same time, don't be afraid to take action and pull the trigger if, even after the stock's recent 50% surge from its lows, you still see a significant gap between its current price and what you believe its true value to be. The market often presents these kinds of opportunities, and it's up to us to analyze them thoroughly and act decisively. Let me know what you think. This brings me to the end of this video. I'll see you again in the next session. Goodbye and happy investing.